Hi, welcome to this quarter's market overview, where we'll share our take on the second quarter of 2024 and our perspective on what lies ahead. I'm Simeon Willis and I'm joined by Emma Coleman, our Head of Credit Research. She'll be sharing her thoughts on the credit markets and interest rate environment we find ourselves in, along with her outlook. In the UK, the quarter sat in the shadow of the election, which is now behind us. As widely anticipated, we have a new Labour government, and with a change in party, we often see some optimism in financial markets. That said, we had a fair amount of optimism priced in during the build-up, so I have to see how markets fare on that front in our next review in 3 months' time. As we often do, let's start with the latest developments in central bank interest rates. Emma, please can you talk us through what's been happening?
During Q1, investors had begun to dial back expectations for immediate interest rate cuts, but we saw inflationary pressures continue to subside during Q2. The European Central Bank was the first major central bank to lower interest rates by reducing its main lending rates from 4 to 3.75%. The central banks of Canada, Switzerland, Sweden, Mexico, and Brazil have also recently lowered interest rates. There was continued economic growth in the US, and this was accompanied by sticky inflation figures, leading to a more cautious expected approach from the Federal Reserve when it comes to cutting interest rates. So compared to the 6 or 7 expected rate cuts we had at the start of this year, the Fed is now on track for 1 rate cut during 2024. Meanwhile, in the UK, the Bank of England held rates steady during the quarter, but is widely expected to reduce them at the next Monetary Policy Committee meeting in August.
Looking to international politics for a moment, political activity around the globe gathered momentum over the second quarter. Prime Minister Modi won an historic third term in India, boosting Indian stock markets to record highs. South Africa's stock market also strengthened after Ramaphosa won a second term as president. The European People's Party, led by Ursula von der Leyen, won the most seats at the European Parliament elections. In France, President Macron called a snap general election after failing to achieve a majority in the National Assembly. French, German, Spanish, and Italian indices all fell in the immediate aftermath of Macron's announcement. In the US, the first televised debate between Biden and Trump aired in June with a disastrous performance from President Biden, which he later blamed on fatigue. The president has since faced increasing pressure to stand aside before November's elections due to concerns over his age. Former President Trump looks increasingly likely to return to the White House when elections take place in November. Around 60% of the rise in the US stock market year to date is attributed to just 5 stocks: Nvidia, Microsoft, Amazon, Meta, and Apple. The strength of the US stock market has been seen to drive global equities on the whole, who've enjoyed another encouraging quarter. In the UK, the London Stock Exchange regained the title of the most valuable stock market in Europe during June. Emerging markets enjoyed a strong quarter, but have lagged behind the broader market so far in 2024. Emerging market valuations, when measured on a market price to book ratio, are in line with long-term averages, with India and Taiwan significantly ahead and China lagging. Emma, what have we been seeing in the credit markets?
In credit markets, UK corporate bonds posted slightly negative returns over the quarter, as investment-grade bonds have some sensitivity to government bond yields, which rose during April. Investment-grade credit spreads were broadly flat over the quarter and remain extremely tight relative to long-term averages. High-yield bonds performed positively overall as corporate earnings and the wider macroeconomic picture remained resilient. Default rates have increased slightly in the past few months, but these are expected to remain contained and in line with the long-term averages of around 4%. Despite government bond yields falling in May and June, fixed interest and index-linked gilts posted negative returns over the full quarter, as they were unable to offset the large rise in yields over April. In terms of our future outlook, as mentioned, public credit markets currently are trading very expensively relative to long-run averages. And this is because of that stronger macroeconomic picture, but also because high interest rates means that the total yield on these bonds is very attractive to investors. So there is strong demand for these assets. Our view is that for investment grade, that strong demand could be set to continue and credit spreads could stay tight. However, we think that for high-yield bonds, these issuers remain exposed to short-term refinancing costs, and there is the potential for spreads to widen there, which is why our outlook is unfavourable.
UK defined benefit pension scheme funding remained healthy over the quarter. The combination of strong positive returns from growth assets and rising gilt yields, reducing the value of liabilities, saw aggregate funding reach its previous high of 115% on a low-risk basis, which was previously achieved in October 2023. So having covered what's happened, let's focus on the future with our outlook. Our outlook has remained the same as last quarter for most asset classes, with a favourable view on equity option strategies and an unfavourable view on high yield that Emma talked about earlier. We've changed our view in a couple of areas. We downgrade our view on listed equities to neutral in light of the strong performance that has already been witnessed, leading to expensive valuations in the US, which dominate the market. We've upgraded our view on diversified private markets. Emma, can you talk us through what sits behind that?
So the Q1 data that we have available for diversified private markets funds indicates that hedge funds and private equity were the key performance drivers for these funds during Q1. We've upgraded our outlook based on the improving sentiment due to greater clarity around the macroeconomic picture, but also due to a number of key opportunities that we think are available to these funds. The first is private equity, where valuations look to remain attractive. Then we have the secondaries market, where there are quality portfolios available at attractive prices, heightened by DB schemes looking to sell their illiquid assets and approach the insurance market. And finally, private infrastructure, where there are long-term, visible and stable cash flows available to investors. So in summary, there are a few attractive areas that diversified private market funds can look to take advantage of, and this supports our upgrade to favourable.
So that concludes this quarter's rundown of the key market developments and what you need to know about. Thanks for joining us. If you want to find out more about any of the issues covered, please check our website or contact me, Emma, or your local XPS contact. Have a great summer.